Deven Choksey as well, who is joining in on the show to discuss individual stocks. Deven, good to have you. And we were just assessing the overall earnings season, and by and large, it's been majority of the numbers in line with what the street was penciling in. And it's been sort of 50-50 with the above and below street estimates. How would you round up the earnings that we've seen? Had there been any numbers or any sectors in particular that have stood out?
Yeah, good morning, Avan. Well, in the backdrop of what has happened in the first quarter and the second quarter, this year, because of the election in the first quarter and then in the second quarter, the budget, I think the government's expenditure program, the spending program, probably got delayed by about a quarter or plus. And as a result of which, I think the overall industrial environment, I think probably did not get enough amount of momentum as I read it, including the availability of disposable surplus in the hands of consumer. I think the consumer demand also remained a little bit sluggish in the first half of the financial year. Maybe it started picking up in the festive season or festive months of October and early November. I believe that I think the numbers could look probably much better in the third quarter vis-a-vis the second quarter. So overall earnings season per se, on one side, we have got the expected lines, things are coming on expected lines. On the other side, I think the possibilities and the promises for the improvement in the third quarter and the fourth quarter could relatively remain high. That would include the likes of banking stocks, that would also include some of the manufacturing companies. In particular, the metal and the commodity companies are likely to show relatively better performance. Of course, I think from the market perspective, because of the US election, the IT sector per se, I think is showing relatively different kind of a strength. But overall fundamental strength, as I see it, I think the metal commodities, the chemical commodities, the banking stocks in particular, I see better earning outlook going forward in the third and the fourth quarter. And of course, including the manufacturing space, particularly the power and power engineering related products.
Okay, lots of pockets to watch out for. But Deven, I'm just going through a Morgan Stanley note this morning, and they say that ICICI Bank has the levers to see further re-rating from here on. It remains their top pick, and they see the improved funding and underwriting franchise to really drive the performance going forward. Do you concur? Because ICICI Bank has been a ranked outperformer this year. I think it's managed to gain, what, 30% plus this year? Do you expect this kind of outperformance to continue further?
Yes, Anish, absolutely. I think the numbers are definitely in line with expectation. The size of the balance sheet definitely is strong enough for the earning momentum to continue. What one has seen, expansion of retail credit, and one has also seen, I think, the expansion of MSME credit. In both this space, I think this company is relatively better positioned. Also, from the point of view that I think they've integrated fintech very well at the front end, which is basically giving them a faster processing of the loan to the retail. And at the same time, I think the higher amount of credit score that they would evaluate based on, I think, the tool that they implemented at the fintech level. So, in my viewpoint, I think they're probably one of the efficient ones as far as I think the lenders are concerned. And I would think that given the kind of a recovery that we are seeing in the second half of the financial year, probably from the corporate side, MSME side also, this company is expected to produce relatively better AUM growth in the second half and thereafter. Maybe the rate cut would probably mean further re-rating of the stocks, which currently is available at a fair valuation, as I would call it as.
Right. Deven, what about metals? I mean, while they move in a cluster, but there are surely some outliers. While it wasn't quite the same commentary from Novelis, Hindalco has been very impressive asset.
Yes, Aisha, I think the numbers quite impressive, and I would remain very positive on the metal and the prospects therein. On one side, we are seeing the stable energy input cost, which is a key raw material for most of the metal commodities. On the other side, we have a prospects of war-related situation getting eased out in 2025. Given that possibility, I would think that the economy would demand higher amount of commodity requirement, particularly I think for rebuilding those countries. And in that situation, I think the metal commodity prices are likely to remain firm with the energy costs remaining low. So it's an advantage structurally, both on one side the higher demand, on the other side the lower input cost. including the renewable energy, which is an input for them in many cases. So, in my viewpoint, I think the ferrous, non-ferrous, both metal commodities are likely to be the outperformers in next 1 year and 2 years from now. So, one would remain bullish on the prospects and the possibilities.
All right, that's the view coming in on Hindalco. Meantime, just checking in as well on some of the other brokerage notes that have come out, and you've got JP Morgan that's come out with their view on LIC. They've upgraded the stock to overweight, saying that growth is likely to remain sustainable, and they are expecting a double upgrade on the strong VNB growth from the enhanced product mix. There's also something like an Aarti Industries that's on Nuvama's radar with a buy rating, although they've cut the target price, saying that the earnings have been disappointing and the dip in margins for the key products as well has been a bit of a dampener. That's Aarti Industries and Nuvama's latest note coming out on it. Wanted to get in your thoughts then on the entire chemical space, Deven, and what your outlook is on Aarti Industries numbers, if you've tracked them.
So I think the in the chemical space in particular, I find that the specialty chemical ones, I think, including some of the newer entrants in the market, particularly likes of Ami Organics, they remain relatively, I think, on a stronger wickets. At the same time, I think some of the major ones like SRF and even agrochemical companies like UPL, they have remained disappointed on their numbers. But I think the smaller companies, particularly those which are having the CDMO contracts and the API arrangements with their customers, they are relatively better off in the chemical and the pharma chemical space. So from that perspective, likes of the Ami Organics, I think is remaining a little bit more sure as far as I think the growth prospects are concerned. Even I think the companies like Archean Chemicals, which is relatively a smaller company, but I think remains a stronger play as far as I think the business outlook on the product is concerned. So we are selectively bullish about the companies within this, and we believe that structurally there is a case for an upside given the lower input cost and better earning prospects due to the higher demand of it for these companies.
Deven, where within the entire infra/construction universe are you finding opportunities to buy still? And I tell you why I asked, because I was just looking at NCC's numbers. I mean, sure enough, the stock has done well. But again, it's all that political and state government sensitivity which continues to keep this one at bay. But still, NCC has really not done bad in the last 2 years. And the numbers as well are looking good. Their order book is now much diversified and not concentrated as the problem earlier with this one used to be. While of course, it's buildings which continue to be constituting a good 37%. It's transport, electrical, T&D, water, railways, mining, etc. as well.
Yeah, on one side, I think the entire infrastructure pack is showing higher amount of order inflow for most of these companies, largely because of the fact that the government-related projects push is resulting into the better inflows for the likes of NCC, which you mentioned, and I think likes of WABAC for that matter, which is predominantly playing a role in the water management system in the infrastructure space. Along with the power and power-related ancillary activities, I think the infrastructure play is going to remain so strong. However, I think most of these companies, as I see it, fully reflecting the possibility of next 2 years of earning into their books, into the valuation. So, from a perspective of looking at the companies on the valuation front, according to me, I think most of these companies are fully pricing the valuation. Unless we see some deep correction, I don't think that I think immediately it makes a case to buy further into the portfolio. Maybe I think the corrected market and on the price front, or maybe I think a little bit of time correction would probably mean that one can buy the stocks into the portfolio because the visibility remains high. But as I said, everything is fully priced in as I see it in the earnings at this point of time.
We have seen a bit of a bounce back when it comes to the IT companies, especially after that election verdict coming out of the United States. Today, of course, LTTS is likely to react to the acquisition that they have made. But what's your sense on IT now? Mid cap, large cap, any specific name?
So we remain cautiously optimistic on the prospects of many of the IT companies. We see on one side a distinct change in the business model, which is now happening. most of these companies, after the AI adoption, are positioning themselves as a platform service provider to rest of the customers on the other side. So using AI, they are developing different kind of tools which are required for the use case of the user industries, which is provided on the platform by some of the larger companies like Infosys, TCS, among others. So all in all put together, I think you are having a larger prospects of better industrial, basically I think activity. Also because of the fact that with America resuming on two programs, one on the tariff and second on Make in America, I believe that I think the demand for IT and IT related service of Indian companies will be on rise. As far as our focus is concerned, I think we remain distinctly focused on engineering R&D businesses of some of the mid-tier IT companies, including the likes of LTTS or for that matter Tata Technologies or Tata Alexis, among others, wherein they cater to the niche segment of the customers, be it in the automobiles, be it in the area of aviation, or be it in the area of infrastructure. I think these companies have the ability to win larger contracts and sustain those contracts for a period of time. So from my perspective of looking at this company, we buy this company in the portfolio, but everything is priced in currently, so I think nothing is available attractive enough. Maybe some correction in the price definitely means better opportunity to buy with the margin of safety as far as the stocks are concerned.
All right. You've also got Nykaa in the spotlight today, set to come out with its quarterly numbers. We're penciling in a revenue growth of about 25%. PAT is seen at 24.7 crore rupees, and the operating leverage in the beauty and personal care segment, the lower losses in Nykaa Fashion, that is likely to drive the margin expansion this time around. But we will be watching out for the outlook on the fashion segment, the new customer additions for the beauty and personal care, and what the outlook is on the EBITDA margin trajectory all in all. Deven, do you track a Nykaa? What is it that you would want to hear from the management?
And on one side, definitely, I think one is very keen to see how they overcome the loss-making proposition in certain verticals. So that is one thing which one would like to definitely keep on tracking for this company. These companies also have a very typical habit of changing the business model very frequently. So I think that is one area where probably I'm not very comfortable or very sure about. You can also see the consumer tech companies, though I think not comparable to Nykaa, but in consumer tech companies like Zomato, Swiggy, and all, they have been also frequently changing the business model, adding I think the newer verticals, keeping the earlier verticals at a commoditized margin front. All those things I think are definitely moving and moving very fast. Market remains a little bit more excited about the possibilities, but we keep an eye on the numbers. I believe that I think till the time we get the compelling numbers, the valuation in command, or maybe control rather, I would think that one will not be in a position to buy these companies easily into the portfolio. As I see it, I think most of the companies are adequately priced today, and the valuations are adequately factoring all the possibilities. So till we see, I think, a sustained profit growth in these companies, immediately buying at a current valuation is not making sense for me. So we just watch it and probably I think buy when market gives a real opportunity at a corrected price.
Right. Okay, that's that on Nykaa. In the meantime, just going to be, looking at how the markets react to the likes of Britannia, Hindalco. These are all stocks which are going to be in the on the radar. And more importantly, whether you see further selling coming in on Asian Paints. We just played that, conference call soundbite as well to you. How is the street going to absorb that and react to that? Devin, what is your sense? You think further pressure for Asian Paints? I mean, not just competition, but pricing, etc. as well has been a challenge?
Yes, I think on one side there is going to be better demand than the first half in the second half for sure. So I think obviously that would be a breather as far as Asian Paint is concerned from the demand generation point of view. On the other side, because of the control prices, I think they should be having relatively stable margin possibilities going forward. I hope that I think in the balance sheet, whatever the inventory that they carry is possibly of high cost inventory which they carried, I think is possibly fully absorbed into the current earnings of the company. If that does happen, then third quarter, fourth quarter may relatively remain better compared to the second quarter earnings that we have seen in Asian Paint. But certainly, I think the higher growth trajectory for this company, one will have to wait and see a little longer. Also, because of the fact that the competition has increased and they would try to create their market presence. So certainly, I think there is going to be a pressure on the price realization as well for the paint business in general. So we will wait and see how exactly the working improves in the subsequent quarters, though there are possibilities which are indicating that it is going to be more on the improvement side than others.
Let's wait and watch how really that pans out. But in the meantime, I wanted to put the spotlight on the auto sector as well. Yesterday, of course, Maruti launched their new version of Desire. That one has done very well for them in terms of the SKU, and they have just launched it at an attractive price point. My colleague Sumit did catch up actually with the management as well. But before we play that soundbite, Deven, what's your sense on autos and within four-wheelers? Which company do you think will outperform? Will it be M&M? Will it be Tata Motors? Could it be Maruti?
A good question, I guess. I think these companies have definitely shown the better abilities on two counts. On one side, they've been very particular about managing their cost well, which they have done so well. On the other side, I think the market situation demands, I think, the newer introduction of model. That's where probably all these three companies are showing robust ability, I think, to introduce new models. Maruti in 2025, early 2025 is coming up with the born electric vehicle portfolio, which is also going to make the difference as far as the perception is concerned and at the same time the business is concerned. Mahindra and Mahindra among the lot, I think, is relatively looking much better because in many of their models, they are still having the waiting period for clearing the order book that they have created. So they are relatively better off. But given the price correction, I would think that Tata Motors would remain relatively more sure about it because the downside is protected. JLR portfolio is expected to show better performance in this quarter and the next. And as a commercial vehicle, of course, I think is showing definitely better signs. So certainly, I think one would like to buy Tata Motors at a corrected price valuation because of the downside risk limited in this stock particularly.
Talking about
Managed to outperform the peers by a good margin. LFL growth on a standalone basis at 2.8 looks weak, but if you compare it with what's happening in the market, stands out. What's the sense?
I would not know Anisha enough about, I think, the current valuations of this company because I have not gone into detail about the results also. So would probably, I think, come back to you at some other point of time.
Okay, Deven, we'll let you go on that note. Thanks as always for taking the time out and joining in. Just going to give those pre-open rates.
If you like this video, then like, share and subscribe to ET Now.